Hi, I'm Ross Mayfield, investment strategist at Baird. We are back for another weekly update with our friends at Strategas. Today, we are lucky enough to be joined by Strategas President and Head of Portfolio Strategy, Nicholas Bohnsack. Nick, how are you doing today?
Very well, my friends. Good to see you. Thanks for having me.
Yeah, good to talk to you as well. Obviously, a lot going on, a lot of things changing very quickly. So I thought we could zoom out. One of the frameworks you all have been using to discuss the market and discuss the potential for a recession is this three C's framework. I wondered if you could break down what the three C's were and then kind of extrapolate on how they're looking to you at this moment in time.
Yeah, for sure. I mean, there's no question. I think for any of us that the environment is fairly dynamic, and ultimately in environments where there's some heightened volatility. I think in particular as you move late cycle, and there's some debate as to whether in the United States' case we might find ourselves in recession. It's always been our proclivity to try to focus on first principles and most specifically, and you mentioned the three C's, sort of the data that really underpin the general strength of the economy. So for us, that's the consumer, it's corporate credit, and it's corporate profits. And I think just to take them in order, mercifully, the consumer has remained fairly resilient through this all. The first quarter they were strong, and we had a nice fourth quarter. The second quarter is a little bit of a broken play, but we've seen some erosion in sentiment, but not altogether have we seen the consumer fall out of bed. And I think the underpinning of this, the labor market, also remains generally intact, and claims are at a pretty low level here as we move into the middle of the second quarter. So all in, the consumer, while perhaps slightly softer, particularly at some of the lower earning income brackets than we saw maybe at the start of the year, generally remains in decent shape. The second C, which is corporate credit, this is to me really very important, particularly in the moment, to the extent to which some of the trade and tariff policies have, created a lot of uncertainty in the corporate sector. We did see spreads break through off their tights and break through the wides of last August. They've retreated inside that level. I think for those clients and those advisors that are paying attention to the credit market, that's a good guidepost in terms of determining whether ultimately some of this uncertainty is going to manifest in a financial event. Heretofore, and mercifully, it has not. And that's why recession is not our base case. The odds have increased, to be sure. Our colleague, Don Rissmiller, on the economics team, has raised the probability of recession to 45%. But corporate credit remains generally in good shape. Again, it's a little off its tights, something we want to be very mindful of as we move through the second quarter. And then the third C is corporate profits. And I've spent a lot of time looking at profits and profit cycles over the years. And you can have environments where profit growth is negative and not have a recession. But it's very difficult to have a recession where profits are positive. And so for the moment, the outlook on corporate profits remains positive. That's good. Expectations have eroded a little bit, particularly for 2Q, and less so for the second half of the year. And as we move into the end of the second quarter, we see some of the pre-announcements come through. I would pay particular attention not to what the second quarter is going to shake out to be, but really how the second half of the year is going to shake out. You're going to see some pull forward of activity in 2Q from manufacturers, perhaps, and importers trying to get ahead of some of the tariffs. You're going to see a little bit of pullback in activity in the second quarter as others sort of take a wait and see approach. But all in, corporate profits remain generally healthy, but certainly less so in terms of outlook than they did when the second quarter got underway.
That's great. So a few things for people to watch: spreads, profits, claims. You mentioned that this is starting to look late cycle, maybe even pre-recessionary, though not the base case. What does the playbook look like for investors in a late cycle environment, whether it's asset class, sectors? Where do you go in a late cycle environment?
Yeah, I think there's two important themes that our clients at Baird should be considering as we move into the middle part of 2025. Number one, and I think our advisor teams have done a pretty good job of this, frankly, but it's not a universal compliment in other shops necessarily. Is that there was a pretty pent up desire to sell out at the end of last year of a lot of Mag 7 positions. And I think a lot of investors didn't want to be the first one to hit the sell button. But the way the adjudication of the tariff policies sort of allowed the market to flush a little bit of that excess. So I'm not convinced that some of the weakness we saw earlier this month was entirely the result of tariff policy. It may have just been some sent up sell pressure that was accumulating, really over the last couple of years in some of the AI and AI adjacent names. So on that score, I think you should take some stock that the market is not altogether weak, perhaps as the beginning of April perhaps portended it to be. You do mention the late cycle, however, and I think it's an important commentary that the leadership coming out of this phase, whatever this phase ultimately turns to be, is very unlikely to be some of the big growth tech names. And so as we move late cycle, I want to pay particular attention to the CapEx players. And I do think that there's also an opportunity to increase general exposure levels to international equities. We've talked a lot in this forum and other things that you and I have done about deglobalization. And I think we'll find over the next 3, 4, and 5 years that allocators generally are going to carry a slightly higher share of international equity in portfolio than perhaps they have over the last decade plus.
Nick, this has been super insightful, very good conversation. Appreciate your time as always, and look forward to talking to you again soon.
Thank you, Ross. Appreciate it.